All right, so today I want to talk about a common investing mistake that a lot of people make, and this isn't just beginners. This is intermediate, advanced people. I wouldn't say necessarily professionals. Very few professionals do this, but and this is blindly index investing into different indexes that have very similar makeups. This is from Cade Investments. Again, I don't know this guy. I'm not trying to hate on him or anything. I'm just pointing out a example here, right? So again, he says 90% of my portfolio is invested in ETFs. Here are my top six: VOO and VTI. Again, that's the Vanguard S&P 500 index, and then VTI is the total stock market index. The third one is the QQQs. Again, that's the NASDAQ one. The fourth one is VUG, that's the Vanguard Growth Fund. SCHD, that's the Schwab Dividend Fund. And then VB, that's the Small Cap Fund, the Small Cap Blend. So, and again, what I mean by this is if you look at the QQQs, if you look at VOO, if you look at VTI, and even VUG, they're all market cap weighted funds, meaning, again, a company with a $1 trillion market cap versus a company with a $10 billion market cap is going to be weighted 100 times more, right? So that's the big problem. Again, if you're going to invest in ETFs, you don't want to do it in ones that have massive amounts of overlap. That's why, again, my personal portfolio, I own 3 ETFs. The one that they have the most exposure to. And again, personally, I don't want anything any more than 10, maybe 20% of my portfolio to be in ETFs personally. 10%, maybe 20 at the absolute most. The one that I have the most in is RSP. That's the S&P 500 equal weight index. So again, it's not market cap weighted. It's weighted equally amongst the 500 companies. And then I have a little bit in the QQQ, and then I have a little bit in VIG, which is a dividend appreciation fund. Again, I don't have an SPY or a VOO position because I already have a massive exposure to those companies, number one, through RSP, number two, through the QQQs. So again, it wouldn't make any sense to buy VOO or SPY, right? So again, a very important thing here. And again, the problem with this is that it's not necessarily a bad idea because it's a hell of a lot better than nothing. But the problem I think that people get here is that they think that they're getting diversification when they're not, right? Because like I mentioned, VOO, VTI, the QQQs, and VUG are all going to have massive amounts of overlap. Like massive amounts of overlap. I mean, you probably think, oh yeah, I'm getting all this diversification, when the reality is you're not. In fact, I would guess is that if you divided up your money equally amongst these ETFs, you have, I mean, the S&P, the VOO or the SPY is something like 30% in the Mag 7. My guess is that if you invest something like this, you're probably like 20%. Right? So you're not changing things as much as you think you are. I would simply, I mean, if it was me, I would get rid of VOO or VTI and the QQQs or VUG. I would get rid of 2 of those 4, like right off the bat, because again, you're not getting the diversification you think. Honestly, I'm not a fan of SCHD either. It is decent quality, but it has grossly underperformed the market over the last couple years, like grossly underperformed. And then VB, I think VB is a very good way of diversifying because that's the small cap index, but why not substitute one of those for the mid cap index, VO? I mean, the QQQs and all of the first 4 are going to be heavily weighted towards large cap. So why not a mid-cap one? SCHD is more of a value-based one, but it's still heavily weighted towards large cap. There's no mid-cap here. And again, the exposure to small cap arguably still isn't even enough. So that is my critique of this. Again, as far as my personal outlook goes on if I were to buy just ETFs, or 90% of my money had to be in ETFs. Like I said, the majority of it, I would have number one would be the RSP, the equal weight. And the reason for that is, again, people say, well, why? It's underperformed the SPY or VOO. But my response to that would be, okay, well, the very, very large mega cap companies most of them are clearly overvalued right now. So that's why I would be more dedicated towards those. And not to mention too, the RSP has a higher dividend yield, and it's growing it a little bit faster as well. So that's my reasoning there. Second probably would be the NASDAQ, the QQQ. That would be my second, because it is somewhat different than the RSP. It's growing faster than VOO or SPY. So that would be my reason there. And honestly, I don't even know if I would add a third one. I mean, I would say maybe you have like 10, 20% in an international fund, but the problem with the international exposure is virtually all of it has underperformed the US markets. So, I mean, if you just go down the list here, China clearly has a demographics problem. Their economy clearly is built on very shady things, to say the least. And it's heavily propped up even more propped up than the US one. I mean, if you look at Europe, I think Europe, they have not the greatest demographics either. And on top of that, they've always grown slower than the US. And on top of that, they don't have as much of a spirit of freedom and the free market. South America, I think, has potential, but they tend to swing very rapidly from the free market to socialism, which again causes a lot of issues, at least as far as the stock market's concerned, to say the very least. I think that there is certainly some opportunity in some of the other Asian countries. Again, you got to keep an eye on the demographics there. I think there's some potential in India, but again, you got to be very careful that you are adding risk, right? I mean, the US has a lot of problems, but on the flip side, they're still the best dirty shirt in town. I think that's the best way of putting it. So like I said, if I were to do it, I would say probably 40% RSP, 30% the QQQs, maybe 10% in VIG, 10% roughly, I honestly don't even know if those numbers add up, but roughly in some form of an international fund. That's probably what I would do if I was simply to ETF or to index. But again, you got to keep in mind that the index is clearly, especially the market cap weighted ones, are a little bit bloated right now. Honestly, I think adding a small cap and a mid cap ETF probably wouldn't be a bad idea either. I'd probably try and get 10% in each of those. I'd maybe lower both of the RSP and the QQQ, maybe 30%, 25%, 25%, 10 to 15 in both the mid caps, and then the rest in an international fund. That's probably the better way of doing it. Because again, you get the growth, you get the value, you get exposure to mid cap, small cap, and large cap. You're not clearly overweight anywhere there. And again, another thing to point out about these market cap weighted funds is they're heavily weighted towards tech and consumer discretionary a lot of times, communications, right? They have very little exposure to a lot of industries that I think are still going to do very good. I think there's a lot of value in industrials, especially right now. There's a lot of value in a lot of those companies. Financials, energy, I think you really got to keep an eye on those. Real estate, again, it's going to depend on rates. If you look at utilities, I think is definitely the one that I wouldn't be touching right now, because utilities are bond proxies in a lot of ways, and I don't think we're going back to below 1% interest rates anytime soon, and if we do, it's because of a major crash. So that's kind of healthcare, again, is going to be cyclical as well. I think there's a lot of people out there that are really big fans of healthcare. My problem with healthcare is a lot of the companies are very hard to value, and especially the biotech and the pharma ones. They're very hard to value, and I think they're harder for the average person, even the average person that's a fairly dedicated investor, to value. I think a lot of the financial ones are pretty clear cut. The industry ones are pretty clear cut, even tech to a degree. But healthcare, I think, is a very hard one. So anyway, I just wanted to make a video on this because I think this is a mistake a lot of people make, is that they think they're getting diversification when they're really not. And you're making things harder on yourself for no apparent reason. And the last thing I'd bring up here too is that I'm a fan of using covered calls to increase your returns over time. And the more stuff you have exposure to, the less you're going to be able to sell covered calls. So that's another downside to just needlessly having extra investments, I guess, for lack of a better way of putting it. So anyway, that's what I wanted to bring up today. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.